analysis of investment risk and return. Welcome to the risk analysis process video. In this video, we'll explain the measures used for analysis, the investment risk and return. After going through this tutorial, you must be able to analyze the risk associated with an investment product based on different measures of risk. What do we do to earn more? We invest in different investment products. But before investing in a product, individuals and their financial planners calculate the expected risk and return that can be obtained from an investment. If the investment is able to provide the desired returns, then only an investor invests in a product. Next, let's see how to analyze risk and return. Investment return, or simply return, is the amount of money generated by investing in a product like gold, stocks, shares, debts, etc. An individual analyzes the return from an investment before investing in a product. Return on investment (ROI) is an indicator of performance measure that is used to evaluate an investment from various perspectives, such as amount of money likely to be received at the time of maturity, the time period, etc. Now let's look at the measures adopted to analyze the investment return. Time-weighted return is a measure of the compound rate of return for a portfolio over a given period of time. It takes into account a specific period of time for a specific portfolio. In time-weighted returns, a set of sub-period returns is calculated whenever there is an external cash flow, like a deposit or withdrawal from the portfolio. Next, the geometric total and the mean return is calculated instead of the arithmetic total and mean return. A rupee-weighted rate of return is similar in concept to the internal rate of return, wherein the discount rate makes the net present value, or NPV. This helps in determining the expected rate of return of an investment, which further enables the financial planners or individuals to allocate the funds or the assets or investment that is providing maximum returns. In other words, the present value of inflows is equal to the present value of outflows. A real rate of return is the annual percentage return realized on an investment and is adjusted for the changes in price due to inflation or other external effects. This method expresses the nominal rate of return in real terms, which assists in keeping the purchasing power of a given level of capital constant over a time. This will help the financial planner or individual to determine the exact amount of return that they will be obtaining from an investment, which further enables him or her to decide the asset allocation while preparing the financial plan. A nominal rate of return is the amount of money generated by an investment before factoring various expenses such as taxes, investment fees, and inflation. This enables the planner or individual to get a rough estimate of the amount of returns on different investment options, and so the asset allocation can be done accordingly. For example, a data on a mutual fund might show the fund's nominal rate of return as 5%, but also show its rate of return after taxes on distribution and sales of fund share as only 3%. Holding period return is the total return which is received from the holding of an asset or portfolio of assets over a period of time. This is generally expressed as a percentage. This helps planner or individuals to identify the assets which were held for a long time, so that maximum returns can be obtained from them. Compound annual growth rate, also known as CAGR, is referred to as the mean annual growth rate of an investment over a specified period of time, which is more than a year. In general, CAGR is used to calculate the average growth of a single investment. It is used to provide a broader picture of the market trends. It will help the planner or individual to identify the investment options which provide a moderate return and consider these options while preparing the whole investment plan. Yield is the return of income on an investment. It may be an interest or dividends received from holding a particular security. It is usually expressed as an annual percentage rate based on the investment cost, current market value, and face value. Yields may be considered known or anticipated depending on the asset an investor has. This enables a planner or individual to determine the amount of interest or dividend he or she will obtain by investing in the product. This will help in deciding the fund allocation in different assets while planning the investment. With return, risk also comes. Now let's discuss about analysis of investment risk. Each investment risk is required to be analyzed to take suitable corrective and preventive steps for future investment decisions. There are some measures for analyzing an investment risk. These measures are used to quantify a risk. Let's look at each one of them in detail next. Variance measure is used to determine the difference between the expected rate of return of an investment and its actual rate of return. Variance is the key parameter in investing and is used to determine the volatility of an investment. The expected value is obtained by using the probabilistic approach. Semi-variance, on the other hand, is a measure of the dispersion of all the observations that fall below the mean or target value of a dataset. It is an average of the squared deviations of values that are less than the mean. It provides a measure of a downside risk as compared to the variance and standard deviation, which provide a measure of volatility. Thus, semi-variance looks at the negative fluctuation of an asset. Covariance is a measure of the degree to which return on two assets which are considered to be more risky move in tandem. A positive covariance means that asset returns move together. A negative covariance means returns move inversely. Covariance is closely related to correlation. Correlation is similar to covariance, except that it is also considers the standard deviation of the investment portfolio. It helps in determining the fluctuation of an investment from its average return, as well as it compares the return from one asset to the return of another asset. This analysis will help the planner to select the asset for investment which deviates less from its average return and gives positive return as compared to the other assets. Standard deviation is the primary measure of risk determination. It is used to denote the fluctuation of an investment from its average return. For example, if the standard deviation value of an asset is 3%, it means that the return on the asset can be lower or higher by 3% from the average return. Beta is the measure of the volatility or systematic risk of a portfolio as compared to the entire market. Beta is used in the capital asset pricing model, which calculates the expected return of an asset based on its beta and expected market returns. Beta is obtained through regression analysis. It represents the tendency of an asset returns to respond to various swings in the market. Let's summarize what we have learned so far. The summary of the tutorial analysis of investment risk and return has been put on the screen. I'll pause for a few seconds to allow you to read it. Before you invest in any product, analyze the risk and return of the product using 3 measures discussed in this video. Thank you for watching the video.